There you can see it. Facebook shares down almost 4% today. So their little mini winning streak was down. Look at that stock price, $31.76. Do you think that that is a fair price for Facebook shares? Mark Hulbert says not necessarily. Mr. Hulbert, how are you today?
Okay, how are you?
I'm doing well. I'm doing well. Let's talk about Facebook. Let's talk about your column today. Very interesting. What is a better fair value for Facebook shares? It's kind of a shocking number.
Well, yeah, it is a shocking number. Basically, I use a number of, I think, very reasonable assumptions about where the stock will be in 5 years' time, and then back out what it would need to be trading at today in order to give investors a good rate of return between now and 5 years from now. I come up with a value of, believe it or not, $13.80.
That's real. I think that's less than Yahoo. Now, what are the assumptions? How does that work out? And why is it trading so high now?
Well, I mean, you'd have to ask the people who are bidding up the price or paid $38 or even what on that first day went up to as high as 42, why they were paying that much. A lot of people, including myself, were saying there's no way the company could justify that high of a price. So I guess it's not for me to try to figure out why people would do that other than to say that, it's an extraordinary popular delusion in the madness of crowds.
Nice literary reference there, by the way. But okay, so why 1380? How do you get there? You talked about your assumptions. Let's talk about the growth rates for the company that you're looking at.
Yeah, a key assumption is how fast will the revenue grow over the next 5 years? It turns out there's a just released study by a number of academics led by Jay Ritter, who's one of academia's leading experts on the IPO market. He's at the University of Florida. He looked at all IPOs between 1996 and 2010 in the US and looked at the average revenue growth rate over the first 5 years after they went to market. Turns out it was a growth rate of 212%. I apply that to Facebook and then look at Google's price to sales ratio on the assumption that Facebook will be as valued in 5 years as Google is today. That's an optimistic assumption, of course. Right. You come using those two assumptions of revenue growth and a price to sales ratio, you come up with that price of, it turns out in my column, I calculated it's at $23 and change of where the stock would need to be trading in 5 years' time. Well, no one's going to invest in Facebook today if it's going to be at $23.80 in 5 years. You back out an 11% growth rate, which is what the market has provided. That's already too optimistic because I think it's so risky that you would need even higher than a market rate of return to justify. But even at an 11% annualized return for 5 years, you'd need to be at $13.80 to provide that kind of return and be at 23 and change in 5 years' time. So that's how I do the calculation.
And it's amazing too. I mean, Facebook actually waited to go public for a long time. I think even 3 years ago, companies would go public earlier in their growth. So a lot of that sort of huge growth, that startup growth, I think that's already been done.
Well, that's right. And that's a very, very good point, because even assuming that Facebook is going to be able to grow at the average rate is already optimistic for the very point you mentioned. Another reason why I think it might be too optimistic is that percentage growth rates are much harder to maintain on a company that's already huge. Right. So obviously, when it's a small company, revenue growth rate is relatively easy. But you know what? Facebook is now the 48th largest company by market cap in the US. It's already huge. It's going to be hard to maintain a very fast growth rate.